With me today is Jordan Roy-Byrne of thedailygold.com. I'm going to spend some time talking about gold stocks, trading, all that good stuff. Jordan, thanks for joining us.
No, Simit, thanks for having me. It's my pleasure to be here.
Just jumping right into things, I guess the first thing that I sort of want to talk about, or as a way of introducing you to people, is sort of, how did you get involved in trading? I know you have a CMT, which, I personally think that's great, and we have a lot of technical traders over at Informed Trades. So if you could sort of provide an introduction of just, how you got into this business.
Well, I back when I was pretty young, probably 14, 15, I just started following the markets, and that was in early 1999, which obviously it was in the midst of the tech bubble towards the end, but right before the final blow-off phase. And even as a kid, I was always interested in money, and so I always knew I would be headed into this kind of profession. And I invested some of my money in the tech sector, and I actually got in early enough that I came out ahead. So I ended up making money, and my mistakes were after the market crashed. I actually I held up pretty well, but then I lost more money as things kept going down. I was buying in 2001, thinking, oh, this is just a correction. We're gonna go to the moon again, and so that was a major learning experience for me. And fortunately, as I said before, I actually didn't lose money. I ended up ahead from where I started, so that was really fortunate. And after that, because it was an experience of reading analyst reports and hearing these people talking about, this company's going to grow its earnings 50% a year for the next 5 years, and I just thought there has to be another way to look at the markets. None of this made any sense, and that's when I started learning about technical analysis. And pretty much since, I would say, 2002, 2003, I was basically looking at hundreds of charts every day, and I had some people that helped me along the way, but mostly self-taught. And I guess, like anything else in life, you have to practice and practice over and over again. And so basically that's, for the last 10 years or so, I've just been looking at charts and reading lots of books and applying myself. And I remember after the tech bubble, I had a mentor who was telling me about gold and oil. And, at first I was like, what are you talking about? That doesn't make any sense. You got to be in tech stocks. And so finally, I think in 2003, I came to the realization, we're in a secular bear market for stocks. The economy's having lots of problems, and we're going to be in a major bull market in commodities. And I didn't have a whole lot of experience at that point, but I was fortunate that I came to that realization so early in the bull market. And so that kind of, cemented my beliefs that you really have to figure out what the major trend is and then trade around that. And I'm not much of I've never been that good at playing markets from a short side, so I prefer the long side. And I feel like you have to play the major trends. What is the secular bull market? What are the sectors that are going to do well for 10 or 15 years? And so that kind of cemented my beliefs. And at first I was in energy stocks, and then 2005, because I wanted to wait a few years on the gold stocks, I wanted to learn a little bit more. And I was really fortunate that I got in 2005 at the perfect time. So, that was kind of a stroke of luck, I guess. And fortunately, I've been fairly successful in the gold and silver stocks, and I've learned a whole lot along the way. They're much, I know we'll get into this later, but as you know, and probably many of your followers know, they're much different from other sectors. They're way more volatile, which provides great trading opportunities. But at the same time, some of the rules that you use for conventional sectors, they don't always play out to your advantage when you're dealing with mining stocks. So that kind of sums up how I got to where I am.
So in terms of, you're talking about looking for, like, James Dines is one notable investor, and he has a similar philosophy of, looking for what he calls a super bull market. A bull market's going to go on for a decade. Ideally you get in early, and then when it really gets to that point, 8, 7, or however long years later, then you start getting those big returns on your initial capital. For instance, if someone who got in at gold at 250, now if it goes up, $50 a day, $100 a day, that's like 100% return or 50% return on their initial investment. So when you were in the about 10 years ago, when you were looking at, you mentioned the energy sector was the first thing that sort of you had sort of gotten into after tech stocks. How do you sort of, or what drew you to, what are some of the fundamental things? Like with gold, there's a lot of the, Austrian economics people. What sort of got you into thinking, what, this is going to be a market that I want to position myself in for a while?
Well, I mean, I read a lot about charts, and some of the books I read, it did mention commodities being in a new bull market. I think one of John Murphy's books said that we were in a new bull market. And then reading a lot of kind of the Austrian views and stuff on a lot of the gold websites out there, it really convinced me. It made a lot of sense at the time, and given that stock, I mean, it was fairly simple to me. I mean, we had a great bull market, and something else has to take its place. And the same thing happened in the 60s and 70s with commodities, and gold stocks had gone up for actually 20 years, from 1960 to 1980. And of course, energy stocks did very well. So it made a lot of sense to me that we're in a new commodity bull market. This is going to continue. And I think the fundamentals made a lot of sense. I mean, you were going to see a huge amount of money printing, and to basically, the economy wouldn't be able to continue to sustain itself because of the levels of debt without continued money printing and easy monetary policy. So, I mean, all of those things tied together. I mean, you really have to look at the technicals and also the fundamentals and combine them. I mean, I remember looking at the oil chart. It had that major resistance at $40, and so when I first got interested in oil, I think it was maybe in the low 30s or something like that, or maybe in the high 20s. And so I was looking at the chart and noticed that, wow, when this breaks above 40, this is probably going to go to 70 or 80. And it's the same thing with gold. If you go back to how it was looking in 2004, it hadn't broken above 500 for 24 years or so at that point, and it had tested 500 several times, or 510 or whatever it was. And so those were two things right there, that both of these markets, the fundamentals made sense, but if you go back to the technicals showed you these markets were in position for a multi-decade breakout. And of course, when that happens, as you know, there's a lot of upside after that.
So in terms of you're combining, fundamentals and technicals. You're mapping out support and resistance and things like that. In terms of gold, or within any of these, really long bull markets, when you mentioned that you prefer the long side. So are you selling? For instance, gold got pretty overheated in September of last year, and then we saw that big correction from 1900 down to 1520 or something like that. So are you, in terms of how you're using technical analysis in these long bull markets, are you using it just to determine when you want to add to your position, or are you actually selling some, or how are you using technicals in these bull markets?
Oh, that's a good question. I mean, I deal mostly with the stocks, and when it seems like the metals and the stocks get overheated, then that's a time to pare down your positions. But actually, because it's such a volatile sector, I mean, for example, silver, I knew once silver went above 40, I mean, it was obvious it was going parabolic. And even when silver was in the mid-30s, the stocks weren't responding well. And so that was a very strong sign that we were near a top. And so when silver went above 40, I told my followers, I mean, we had already sold some things in the 30s. I was definitely a little bit early. But given how volatile the market is, I mean, this sector, I mean, the corrections are so wild that, I mean, you almost have to, depending on what you hold. I mean, I think you can hold the metals, but you have to trade the stocks. And so I kind of view things as maybe like a 9-month or 12-month time frame, and then if you're in a good situation, like if you bought at the end of 2008, depending on what it was you bought, you might be able to hold that for a couple years, for longer than a year. And I think we might be in a similar situation where if you bought some things in the last couple months around that May bottom, you might be able to hold that beyond 12 months. And of course, depending on what it is, I mean, a lot of the smaller, more illiquid, non-producers, I mean, those are things you have to watch really carefully. But so that's kind of the time frame I look at, and you know, as far as the charts, I mean, if something gets way too far above its moving averages, I think that's kind of a helpful idea of knowing when to sell. And of course, I mean, that's the most difficult thing in trading and technical analysis is knowing when to sell.
In terms of, so you mentioned that you're holding stuff for on average of like 9 months to a year. Is that correct, or?
Generally, yes.
So I mean, these must be. What type of market cap are you usually looking at for something like that? It must be like a few hundred million or less than that, or?
Well, generally, I mean, I like to look for something that's maybe like 100 to 300 million market cap, or because I mean, I like to look at those types of companies. They're established. They have a lot of cash. They have proven management, and then looking at it, you just know that it's going to be a big time company. It has a chance to be $1 million or $2 billion company. So that's kind of what I look for. Try and spot companies that are small but established, and they really meet your criteria for something that has a good chance to really grow for several years. And that's another thing I've noticed in this bull market, and also in the mining industry, is there tends to be like a 2 or 3 or sometimes 4 year cycle. So that's, I mean, if you go back to we had a cyclical bear market, of course, at the end of 2007 and into 2008, and then we had a cyclical bull, which in the silver stocks I think was about 2.5 years, or maybe, yeah, it was about 2.5 years in the silver stocks, maybe a little bit longer, and then in the gold stocks. Well, I use December 10 as the end of the cyclical bull market. So that was a little more than 2 years. So that's another thing I also look at. I mean, looking at where we are now, for example, I think a new cyclical bull started in May, and we're in I think the 12th year or so in the bull market for the stocks. And so I'm thinking if we have 5 or 6 years left in this bull market, we'll probably get a strong 2 or 3 year run, and then maybe a sharp pullback for a year, a little bit longer, before we get a final parabolic move. So the things that I'm looking at now, I'm kind of focusing on, okay, what is this potentially worth in 2014?
Okay, you've been mentioning a lot of, or especially, just now you were talking a lot about cycles. So in terms of your, technical analysis skill set, are you using, there's like Gann lines, Elliott waves, there's, Martin Armstrong's, his own unique economic confidence model. Are you using those types of things in your analysis, or what's your technical analysis toolbox like?
Well, I'll say that I'm not. I mean, I used to be a fan of Elliott wave. I think markets can move in that way, but to try and sit down and plot out, which wave we're on, it just doesn't. I don't think it really helps you make money. I'm a big fan of intermarket analysis, which is looking at how all the markets are moving at once. And for example, I noticed that looking at Treasury bonds, the gold stocks tend to bottom 1 or 2 months before Treasury bonds peak. So back earlier this year, when we were in the spring and bonds were really getting overheated, that was another reason I was getting more bullish on the gold stocks and expecting, a major bottom there in the spring. And I'm actually working on an update today. I mean, I focus on the gold stocks, but once or twice a month I put on an update on all the other markets, because it's important to know what's going on there. And looking at bonds, they do look like they could rally a little bit more and recover here in the next month or so. And so that, I mean, that's another factor. Of course, precious metals got short-term overbought, so I was getting short-term negative, and then we have the October seasonality, and then again, looking at intermarket analysis, looking at bonds right now, they kind of look short-term bullish to me. Commodities to me look like looking at the monthly chart of the CCI, it had a good rally, it hit resistance. I think the bottom is in, but it could pull back for a couple months. So I'm looking at all these things and piecing together what it means for precious metals and the stock. So intermarket analysis is really one of my favorite things to look at. And then, I mean, I also love looking at sentiment indicators. I mean, looking at public opinion. It's just very simple. And looking at the COT structure, things like that are just simple to look at, and they they really tell you what's going on. Are people moving their money in? Are people way too cautious? Are people way too optimistic? And that's what we saw in the last couple of weeks. I mean, people have been really piling on the speculative side in the precious metals. And, I mean, it's nothing to be worried about beyond the short term. But, I mean, looking at that and then combining it with the fact that 35 was resistance for silver, 1800 was obvious resistance for gold. So I'm trying to piece together as many things as I can on the sentiment side, and of course also in terms of pure technicals. And also I would point out, back in May I was looking at the valuations of the senior gold producers, the price to cash flow, where the valuations were actually very close to the levels we saw at the 2008 bottom and even the bottom in 2000. So I mean, we spoke about it earlier. You have to match fundamentals and technicals and also sentiment. So I try and look at all those things and piece them together. I mean, even though I say technical analysis is my bread and butter, but I mean, as you know, doing technical analysis, people who don't know anything about it, they think, oh, you're just looking at a chart and you're just guessing as to how the price action is. But it's really, you're looking at factual, hard data and using that, I mean, numerous amounts of data and looking at all those things, and you're looking at all the evidence, I should say, and the evidence tells you, it leads you to a conclusion, it leads you to a risk reward. It leads you to a point where, oh, does this market looks like it's bottoming, it can't go much lower, it's in our favor, or like with precious metals in the last couple weeks, everything was pointing towards getting a short-term pullback.
I know, I know you spent a lot of time interviewing CEOs. You do a bunch of podcasts and are on your YouTube channel with executives of mining firms. So, so far it seems like, or what we've talked about, your approach involves, moving averages, or your sort of a lot of price analysis based on the chart. Valuation analysis, cyclical things, sentiment things. But are you using also like real industry-specific things, almost like geology things, like, are you considering grade? I know there are some people that come up with a valuation ratio based on the NI 43-101 report, things like that. Are you looking at things like that when you're as part of your analysis with gold stocks, and silver as well?
Yes, I do look at those things. I do. In my service. I mean, I like to tell people it's probably half technical analysis and then half, well, I should say it's half market timing and then half, focusing on companies, because the thing with, I'm tired of mainstream commentators talking about how bad the gold stocks are. I mean, it is a bad industry, and the gold stocks historically over time do not outperform the metal. That's very important for people to understand. It happened in the last bull market. But there's still, I mean, you got these thousands and thousands of companies out there, but there's still, a 5% of those which are really good companies. And so, yeah, maybe there's thousands out there, and I'm probably strongly following 20 or 30 or 40 are the ones that I think are viable and the best. And so that's what I like to do, and I do use a lot of those things. If it's a company that's not a producer, I focus more on its resource and what's the potential value. I mean, if it's a non-producing company, you have to look at their resources and kind of figure what is their path to production. How long is it going to take? How much money is someone going to buy them out? And so those types of things. You look at the 43-101 resource, you see what the value is compared to its peers and the industry average. And then looking at producers, I like to value things based on cash flow, and so I pay attention to what the average valuation is. I know a while ago, I think it was maybe 8 times cash flow for junior producers, but for the kind of smaller producers who have some resources and reserves, They tend to trade at, I think, 6 times cash flow, and then the stronger junior producers that are growing and maybe they're producing 100,000 or they're producing more than that, they'll trade at 10 times cash flow or more than that. So I look at these valuations and I figure out okay, if the average of the industry is 8 times cash flow now, but if we see gold go up to 2,300, then things can trade at 14 times cash flow. And conversely, if we go down a little bit, the company based on this will be worth 7 times cash flow. So in my reports, I look at a number of different scenarios and figure out potentially what the company is worth. I mean, what is it worth at 1,700 gold? What would it be worth at 2,000? Does management have a track record of executing? So on the fundamental side, I mean, that's what I look at to find what I think are really the best companies, and then and also the chart plays into that, because if you like the company fundamentally, but then the chart looks pretty bad, I mean, that's kind of a bad sign. That's something you have to be careful of. So I do that kind of fundamental research, and then I look at the chart and project, what is the chart saying? Is there a strong target somewhere? And also when we get, because obviously some of these great companies, they've been doing really well, but the key is to keep them on your watch list, keep holding them, and then, if we get a pullback in the market, then that's the time you want to buy the strong companies. And the last thing I would mention is every year in the gold stocks, there's always 2 or 3 20% corrections. So again, it's great for traders. I mean, we're probably seeing a correction here right now, and it's probably going to last for another couple of weeks at least. And so this is an opportunity for people who, maybe you missed the rebound in the summer, but now all those stocks are pulling back. They're going to pull back some more, and now's the time to do your fundamental research and look for those companies that have strong charts and are just pulling back.
I was looking on your website, thedailygold.com. You've got your returns posted, from your newsletter in terms of how you did last year, year to date this year. So year to date this year, I think you're up 32%. Pretty solid, and still have 2 months left. Last year, you were down 6%, but in light of how I mean, the stocks really got hammered last year. So in terms of risk mitigation, I know I was down closer to, in the high teens, 17, 18%. So how, in terms of risk mitigation, are you using stop loss orders, or what's the way that you're sort of, minimizing risk?
Well, in our portfolio for much of last year, we were heavily in cash, but we did have a couple things that dragged down performance. But I think I do talk about, I have these rules which I figured out, which I was following, but I never really wrote down. And I think one thing when you're participating in the sector, I think you have to overweight, and this is probably true for any trader, but overweight your best ideas. I mean, you don't want to, because some newsletters are recommending 25 stocks, and maybe you have 2 or 3 stocks that you're really, really confident in, but then you have 10 others that are weighted the same, which are just kind of like, yeah, we'll buy this here and see what happens. So that's one thing. I mean, fortunately, my best picks in the last couple of years have always done really well, and it's kind of the ones lower on my list that have dragged down performance. So, and it's difficult because obviously you don't want to have all your money in 4 or 5 stocks, but you can balance that out by having a big cash position. So that's something I try and do. Really focus on my favorites, overweight those, and you have to look at companies that are making money. I call them growth-oriented producers. I mean, some of the royalty companies also follow in there. These are the stocks that are going to give you your growth. Yeah, they're very volatile, but they're going to continue to rise over time. Whereas all the non-producer stocks, I mean, 95% of the go up will come right back down. So those are ones that you really need. You need to understand their speculations. When they go up, you probably should start selling on them. Again, depending on a number of factors. But so these are some of the things I've tried to use to mitigate risk and things that I'm also paying attention to now.
How about in terms of though, So let's say, for when a position is going against you. So, we've talked about how, when the market's really rallying, you'll know, or if it's going parabolic, you can look for some technical signs, valuation ratios. They'll tell you when to start taking profits. But if something is really going against you, do you wait for something that changed your thesis, like you thought the mine was going to be more productive and it's not, so they're not meeting the production output, so that'll be a reason to sell, or a management change, or a technical thing? What about in terms of managing losses and cutting losses? How do you sort of deal with that?
Well, that's a really good question. I mean, when I started off, it was in 2009, 2010, and I was really big on the silver stocks, and I was fortunate that really hit a home run there. And then I started in early 2011. We did get that bottom in January, and so we had a bottom in January. We did rally pretty well into March, and I was getting pretty optimistic at that point and recommended some things, and I mean, that's with companies that are your non-core companies, ones that aren't your favorites. If it's not one of your best ideas and it starts to go against you, I mean, I think that's something that you would cut. You have to cut that sooner rather than later. It's something I just did with an exploration stock that we jumped into, and it started going down again. And even though I really like the long-term value, it's just there's no sign that it's going to go up in the next couple months. So I told people to sell that. So I guess with your core favorite positions, you can be a little more lenient there. But when you're using other things that fill out your portfolio, if it starts working against you, I would be more inclined to cut that sooner rather than later. So to kind of summarize my answer, in the last couple months, that's something I've been more focused on. That definitely, in 2011, that probably hurt my performance a little bit. That we did have a couple things that there was one exploration stock that we got into at 90 cents or $1, and it went up to $1.50, but then it went all the way back down to 40 cents. So I mean that's one thing I've thought about. I really have no answer for that. How you in that type of situation, what you would do. But generally, this is probably the third time I've said it, but if it's a non-core position, or whatever you're trading, if it's not one of your best ideas, and it starts going against you, that's generally the time you want to cut it. You also have to be aware of how the market is doing. Like if we're, let's just assume that we're correcting now, and precious metals, they bottom at the end of October or early November, and things start rallying. I mean, if you're buying things and they're underperforming a really good market, that's also a sign that you need to drop that position, because when the market's doing well, you don't want to be in the losers.
In terms of gold versus silver, or precious metals versus base metals, do you have I guess, how are you sort of viewing gold and silver? Do you sort of view them the same, or is there a big bias towards one over the other? We know silver can be, way more volatile. But in terms of when you're looking at a company, are you more attracted if it's producing more silver, or how do you treat the metals relative to each other?
That's a good question. I mean, I generally am more of a gold bug, but looking at silver, as we know, it always does. If gold does well, silver will always do well, generally speaking. And I think we're in that type of situation here and now. So in the last year and a half, I have avoided, I should say when I started out in 2009, or at least when I started the daily gold at that time, obviously silver was in a really good position. And so I was more optimistic on silver. But in the last year and a half, we kind of had that cyclical bear. I was fortunate to be much less exposed to silver. That's one thing that helped me avert disaster, I guess.
Sure.
But coming back to where we are now, I mean, silver, it's bottomed for sure, and gold also looks pretty strong. And so when they both start moving up again, it could be after this correction. That's the time when you probably want to look at silver, because you're going to get more leverage there. So I'm a little bit more interested in silver right now. I mean, assuming I'm correct and we're going to see a strong move into the winter. But I will say, if I want to be, if you want to be more cautious, then you definitely want to limit your silver exposure.
In terms of we talked about how you like things in the 100 million to 300 million market cap range, or that's where you can get the a quick double in 9 months. Do you have any, or is any part of your portfolio geared towards the larger companies, the Franco-Nevada, Gold Corp, where it's $8 billion, $30 billion valuation? It might not, or well, some of them actually could conceivably double in a few years' time, but generally they're going to be significantly less volatile than the really small small cap stocks. What are your thoughts on some of the bigger ones that may even issue a dividend?
Well, I will say in the portfolio on that I use in my service, Franco-Nevada is one of the 11 long positions, and I recommended that I think last maybe October, September 2011, and so it was obviously we're in a tough market, but it's done really well, and so I'm glad I did recommend that because some of the other ones didn't do as well. But also one thing we do in my service, I talk about, I don't track the speculative positions, which are warrants, but I am very bullish on the Franco-Nevada warrants, both warrants. That's another way to get leverage is, like you were saying, Franco-Nevada, it's a blue chip company, it's a great company. They have warrants that expire in 2017, and you can still get more than 4-to-1 leverage on those. And they're pretty close to the strike price. So, I mean, warrants are a whole nother conversation, but if you look at Sandstorm Gold, which I'm sure you're aware of, that was one of my favorites in 2011. They also have warrants, so the stock has done really well. But if you own the warrants, you probably doubled or tripled what the stock did. The same thing for Argonaut Gold, which has been a huge winner, one that I've been really hot on for a long time. And they also had warrants, which I bought into a year ago, and so those have been a huge winner. And so that's one thing that I try and tell my subscribers is if you're going to speculate, I really prefer the warrants because you can get warrants that are associated with a Franco-Nevada or with a Sandstorm, with these companies that are making money and are very reliable. So personally, and this is one of my 7 rules, I spoke about a couple of them before, but one of my rules is to, if you're going to speculate, really look at the warrants, because those have, if you can pick the right company and they have warrants with a little bit of leverage, you could really tremendously leverage, leverage what the stock is doing. So I tend to really prefer warrants on those types of companies as a means of speculation rather than speculating on this 10 or 12 cent junior stock.
Right. In terms of as you know, or as we talked about a little bit earlier, we've been in this bull market in metals now for 12 years. How much? Do you have any thoughts on how much longer it's going to last? I think you mentioned 3 or 4 years. Earlier in this interview. What are your thoughts on sort of how does this get resolved? Where is the true cash in all your chips and look for the next super bull market?
Well, that's really going to be super difficult to figure out. I wish, sometimes in interviews I've asked other people this and they haven't given me much of an answer. But actually earlier I think I said 5 or 6 years. I did notice, which is very interesting, I think it's a website. I think it's called Cycles Pro or something. But they actually pointed out how every 17.5 years, there's a cycle between hard assets and financial assets. And now, hard assets actually, this cycle, I don't know when it shifted, if it was the end of '99 or at some point in 2000. But projecting forward, roughly speaking, I'm looking for 2017 or 2018 to kind of be a top, and so that's why I think there's 5 or 6 years left, and why I kind of, as I said before, the question is, how is that going to play out? And we're probably going to have two cyclical bull markets in there, and probably a sharp cyclical bear that may only be a year long. So to simplify, we bottomed in May of this year of 2012. Maybe we go up for 2.5 years into sometime in early 2015, and then maybe 2015, the whole year is kind of a sharp pullback, and then we have the final blow off in 2016 or 2017. So that's kind of potentially how I'm looking at it. And I did a presentation at a conference in Toronto, and it's very, very interesting to me how all bull markets and equities follow a similar pattern, which is essentially you can break it down into 3 phases. The first phase is 5 or 6 years where it goes up, and then it has its first major top. Again, with in gold stocks is 2007, 2008. If you go back to tech stocks, it was 87. If you go back to Japan stocks, it was 74. If you look at the 42 to 66 bull market, you can even say that it was 1946 or 47. But after the beginning of a bull market, after a 5 or 6 or 7 year rise, you get that first major top, and then in every one of these bull markets, it takes the bull market 4 or 5 years to essentially break past that first major top. And that phase that you're in there, that 4 or 5 years, I call it the wall of worry phase. And the very interesting thing is, in that phase, companies continue to make money, but valuations go down. So in other words, in the first phase, you have earnings are rising, valuations are rising. That's why you have really good gains. Then in the next 4 or 5 years, you have earnings rise, but valuations go down, and that's why you essentially don't really go anywhere for 4 or 5 years from the point which you started at, that first major top. And then when the market finally breaks out, it has a lot of momentum, and the reason why that third phase lasts for several years and then goes into a bubble is because of what happened in the wall of worry phase. Valuations are very low, and you have the combined effect where earnings continue to rise, but valuations start from such a low point that they continue to rise. So you have this really powerful combination. And the other thing is, in that wall of worry phase, which it tends to be the 7th to the 12th year of the bull market or something like that. Obviously, it takes the market a long time to make a new high. Valuations are going down, which is good, but people are pessimistic. So a lot of people get out of the bull market. They say it's done. It's been going up for 10 years. So in terms of sentiment, you have only the true believers who are in. So you have coming out of that second phase, you have a powerful combination of all these things which can really set up the breakout, and then after the breakout, after a couple of years, then the market, it's in position to kind of move into that bubble phase. So I know I kind of went off track, but I'm so amazed at how all these bull markets follow that same pattern. And the gold stocks from 1960 to 80, they had their second major breakout was in 73. They went up for a couple years. They had a sharp pullback, and then they went parabolic the last 3 years or so. The gold stock bull market then wasn't as strong as the other equity bull markets. But I will say that the current gold stock bull market is stronger. It's on a stronger path than the one from 1960 to 1980. But I do think, once we get into that phase, I think things will get a lot more speculative, and at that point you will want to migrate lower on the food chain, look at the small producers, look at the established companies that have warrants. A lot of the juniors will start to go crazy. So that's kind of, it's a long answer, but that's kind of where I see things evolving in the next 5 or 6 years.
Yeah, so I think there is definitely a lot of ways of looking at those. I've definitely heard something similar, or a lot of perspectives on dividing long bull markets into 3 phases, like you sort of described. Some people may describe different phases slightly differently, but that basic idea. It seems like, or are you of the opinion that May of 2012 was sort of the beginning of the third phase, or is that, you wouldn't say that?
Well, I mean, there's really no scientific way to call it. I mean, you certainly, it kind of depends on what bull market you're looking at. The other interesting thing is, similar to the S&P and the NASDAQ, they actually made a marginal high, I think, in 1990 or so, and then they had a pullback before they started to go up after that. And so gold stocks have actually they've actually followed the S&P very similarly. And so I mean, you can, either or is correct. It really depends on the technical analyst, because some will say, yes, we did finish the phase, we're at a major bottom, but then, the other technical analysts will say, no, we're not into the next phase until we fully break to a new high. So I guess, I mean, there's two ways to answer that. But I guess, how I would say it is we're heading into that next phase. We're on the way into the next phase. And when we do break out to a new all-time high, which my guess would be early 13 to the middle of 2013, as far as the stocks, that would be the point when you say, okay, it's confirmed that we're now at the very beginning of the third phase. And the third phase in some bull markets can last. In all of these bull markets, it's the longest phase. Even in the Japan bull market, the third phase was, I think, 11 years. So I should mention, the third phase can last 7 to 11 years. And it was 7 years with the gold stocks from 1960 to 1980 in that bull market. But then that begs the question, well, was the breakout in 2010 or was it in 2012? So, I'm kind of, to answer that, I'm looking at a bunch of other things, and that's how I came up with the 5 or 6 years. So that's kind of what I'm looking at.
So 2015, based on that, I know I'm just thinking of the NASDAQ bubble. Maybe I'm trying to put that into the three phases that you're talking about. It seems to me that the NASDAQ, the third phase, maybe started, I don't know, 95-ish, maybe. It depends on, I think Netscape IPO was 94 even, and maybe if that, or the internet, and then there was Microsoft and some other tech companies, in the late 80s or before that. But then that would last, up until 2000, was the March of 2000, I think, was the top there. So that's 5 years. But if it's 7 years, like you were saying, or if it's the longest, phase 1 is, or phase 3, excuse me, is longer than phase 1. Then phase 3, that could start, or that could run 7, 8 years, possibly longer. So now we're looking at 2020 or 2020. You think that's reasonable, or?
That's a good point. Let me just cut in for a second.
Mm-hmm.
Yeah, the NASDAQ, I think it was 1991 where it broke out. So I have that third phase is penned at 9 years. If the third phase lasts, longer than 7 years, I would say you could almost divide it into two phases, where you have the beginning is kind of the breakout, and then you have the breakout move, and then the second half of the third phase is of course the bubble move, which you correctly said started there in 95. So it kind of depends. I mean, if again, we're just speculating because we don't know if it's going to last 8 or 9 years or 5 or 6 years. So it's really, I mean, it's difficult to say. But aside from the gold stocks, when you look at the stock market from 42 to 66, you look at Japan and then you look at the NASDAQ. The third phase in those instances is almost two phases by itself. You had the breakout move for 3 or 4 years, and then you had you had the last 4 or 5 years, which were more parabolic, especially in the case of Japan and NASDAQ. And the sign of that happening is valuations just really getting out of control. So that's the valuations just really getting out of control, and that typifies, I guess, the second half of those long third phases. But again, going back to gold stocks, we only have one bull market we can look at, so there's not a lot of information. We just, unfortunately for guys like you and me, there's not enough information at hand to really project, is this going to last 5 years or is it going to last 8 years all the way to 2020? I don't know. That's just, my guess is 2017 or 2018. That's just, if you have to pin me down, that's my guess. But it's just a guess. It's based on limited fundamental data, because we've only had one gold stock bull market.
Okay, I think that sort of covers all the issues that I sort of wanted to go over in this interview. I think it's been a great interview. How about telling people if they want to follow you and telling them a little bit about your service?
Well, they can follow my website, thedailygold.com. I have a free newsletter where I kind of link to my interviews and some of my free articles, and I do give some snippets of stuff we're doing in the premium service where I focus on the gold stocks, and I like to do lots of charting, but also I look at I write reports on these companies and project fundamentally where I think their value is, and again I fuse that with technical analysis to make recommendations. And I also, once or twice per month, I do an update on kind of global markets. What are the rest of commodities doing? What are bonds doing? And I mean, at the end of the day, I'm just trying to work really hard, and I mean, it's a labor of love, and I want to help people make money. I mean, if people aren't making money, then people are not going to renew, and I'm not going to build a big following. So that's what I'm trying to do, is help people make money. And because I believe, as we spoke about at the very beginning, you have to really be focused on the major trend. And the major trend right now is the bull market in gold and mining stocks. And I think that's where it's where the fun and the major profits are going to be for the next 5 or 6 years.
Sure, that sounds great. For people who want to follow Jordan, that's thedailygold.com, as you mentioned. Jordan, thanks a lot for taking the time to do this interview.
No, Simon, thanks for having me. This was one of the best interviews I've ever done. It's my pleasure and kind of you to invite me on.
Great, great. Thanks a lot, and we'll talk to you later.
Thank you.
Take care.